This is Tom Fox. Welcome to the newest edition in the Compliance Podcast Network. My latest podcast, Compliance and Coronavirus. As the voice of compliance, I wanted to start a podcast which will help bring both clarity and sanity to the field of compliance, the compliance practitioner, and indeed the compliance profession during this worldwide health and healthcare crisis. Taking up a variety of topics as diverse as working from home to sporting events, to the role of the board of directors, to crisis management, to the role of supply chains. We will look at all of these in this podcast. If you have a topic you'd like covered on compliance and coronavirus, please let me know. I'd be happy to do a podcast on it. In this episode, I welcome back Ray Dookhie, Managing Director at K2 Intelligence Fin. We take up the issue of unemployment fraud. And while many don't think that this is a major issue, it's become very important for employers and financial institutions during the era of COVID-19. Hello, everyone. This is Tom Fox back for another episode. And today I have back with me Ray Dookhie. Ray is with K2 Fin, a managing director. And he was interviewed for a Wall Street Journal article this week that really caught my attention. And because, frankly, it was not something that was on my radar around fraud or compliance issues or really anything, perhaps even money laundering as well. But Ray graciously took some time to come on the podcast and talk to us about this. So, Ray, I was wondering, first of all, you could tell the audience a little bit about your role at K2 Fin.
Sure. Thanks, Tom. It's great to be back with you. As you mentioned, I'm a managing director with K2 Fin. I lead the firm's fraud risk management services, and that's effectively helping our clients put in place those programs and controls to prevent, detect, and respond to fraud and misconduct. So great to be here, Tom.
So, Ray, we had a chance to visit a little bit earlier, and you gave us some of your thoughts about where we were at that time in the pandemic. We're now 8 months into it, and the challenges for financial institutions have grown, have morphed, and unfortunately, the bad guys, when you figure out one way to prevent them, they just move to something else. And it seems like they've moved to something else in the big way because recently the Treasury Department's Financial Crimes Enforcement Network issued an advisory on unemployment fraud. And could you tell us what that is, and maybe we can explore that in depth?
Sure, Tom. So unemployment fraud is simply the theft of unemployment benefits through the use of false information or false pretenses. Some of the types of schemes that can include identity theft, whereby fraudsters effectively steals the information of unsuspecting persons and use their information to file a claim with the government for unemployment benefits. Another scheme could involve the use of just fake or phony applicants. They make up individuals and use fake information. There are also schemes whereby, employees and employers collude to create false claims and then split the unemployment benefits amongst themselves. So it's a wide-ranging set of schemes that fraudsters can perpetrate.
So what are some of the red flags that would help a financial institution identify unemployment insurance fraud? Sure.
There are many. I think, banks, FinCEN, I think, recognize that banks are a key player here, and they've put out this guidance. And in that guidance, I think it's a prime source of information for bank compliance officers and investigators. And it lays out some of the various schemes that these fraudsters and fraud rings can perpetrate against these banks. And there are things like some of the ones that caught my attention, Tom, are, if a bank account was set up for the sole purpose of receiving unemployment, benefits, that to me is questionable, right? So an ordinary person just don't set up bank accounts just to receive unemployment benefits. They have all sorts of things that would go through their transactions, transfers, etc. So that's a red flag. Another red flag could be an account holder that's receiving unemployment benefits from multiple states, right? typically, a person works in a regular locale. There may be very rare instances where you have someone work in New York and New Jersey. They have two jobs, possible. But if you're talking about 3, 4, 5 different states, checks are coming in from these different states, that becomes a red flag. Or if they're receiving unemployment benefits from a different name, right, of a person, the benefits are coming into an account with a different name, I think that also is a red flag. Another one that I thought was very interesting is if you have a login to a bank account from an international IP address. That is, again, there could be legitimate reasons for that, but it's very rare that you would have that instance. Or if you have immediate transfer of funds, funds come in and then, within minutes or seconds, the funds is transferred to an international bank account. Those are just a few examples, Tom, but people should read the FinCEN alert. It has a wealth of information in there.
Ray, let me see if I could pick up on a couple of points, because I had originally thought this was a financial institution problem, but this is much broader, and it really emphasizes to me the invidiousness of white-collar crime. Because if there is identity theft, first of all, the person who had their identity stolen could potentially suffer some sort of sanctions if a state tries to recoup money that was paid illegally. But companies pay for unemployment insurance with a retrospective application of how much benefits they've been paid out on their behalf. So in every quarter, a company, and I'm an employer, so I know this, an employer has to report the number of benefits or employees who've received benefits. That then every state uses that to determine how much tax to put on an employer going forward. So in Q1, I'll have to report if I had any employees laid off. Q2, the same. And then my rating would be adjusted, and there could potentially be a higher unemployment tax from the state of Texas. So companies could actually suffer from this as well. And that it all really ties back to your point that banks are on the front lines of this, and that banks need to be able to get this information not only to FinCEN, but state regulators. I don't know if they can go down to the granular level of a company, but this type of fraud really could reverberate literally throughout the economy.
No, absolutely, Tom. I think to put a very fine point on this, unemployment fraud, like insurance fraud, hurts all of us, right? The more claims, the more losses that, an organization or the government sustains. I think that cost is then passed on to the consumers, right? And effectively, we're footing the bill for the frauds, right? And so, to me, it's incumbent upon organizations, banks alike, to do everything possible to, protect against these type of fraud schemes.
So, Ray, how are you counseling your clients, or how are you having discussions with financial institutions around this type of fraud? Is it simply they're looking at this going, oh, my God, one more thing? Or are you able to really sit down with them and say, look, because of where we are, and we're recording this in late October 2020, where we are in the pandemic, this is an emerging risk, and it's a risk that you need to put on your risk profile and try to manage it through the identification of suspicious activity or red flags? Or how are those discussions going between people like yourself and your clients?
Yeah, a great question, Tom. As you know, financial institutions, many of them have robust surveillance programs currently in place. Depending on the size of the organization, it may range from, at the lower end, some sort of ad hoc monitoring program that they have in place, or, in the higher end, perhaps some more technologically advanced systems to spot these, including like artificial intelligence, to spot these types of indicators. I think regardless of the size and complexity of programs, the conversations I've been having are around program effectiveness. So surveillance program effectiveness. And telltale sign of a well-oiled surveillance program is around how often it's updated to reflect the current environment, the current fraud schemes that are out there. And so many of our clients are in fact leveraging this type of information about the new and emerging fraud schemes to then update their surveillance metrics, right? Their key risk indicators to spot these types of fraud schemes and then investigate them and run them to the ground. And so I've been advising them, look, if you haven't done it already, take a look at this FinCEN alert and use it to update your program. It's as simple as that. Now, some of our smaller clients, they may need some assistance with the sheer volume of information that's coming through, right? So, for example, if they're being targeted by some of these international fraud rings, there might be significant volumes of investigations that are undertaken. And I think that could overwhelm, a really good established system will tend to spot more of these frauds and therefore requiring more investigations. And so my concern is not that, our clients won't update their program. My concern is that they may not be able to handle the volumes of issues that are coming through and being investigated in a timely and promptly manner and then subsequently reported.
Ray, you work with financial institutions literally of all size, from multi-billion to much smaller institutions. Do you find, or in the financial institution arena, is the smaller financial institutions the ones that tend to get targeted because they can be overwhelmed, or is it really that's not a metric that you really have to concern yourself with?
No, it's certainly of concerns. Now, the popular banks get their fair share of this, but they tend to shut down the schemes faster. So the fraudsters, they tend to go after sort of the weakest vulnerability. It's kind of akin to, the home robber walking by the neighborhood and seeing, the ADP sign up, right? And say, you know what? I'm not going to target that house. But they, walk down the block and in there, there's no security system, or the security system is lax. The camera is hanging off the wall. It's not really working. And so they would tend to target those. And I'm not saying that, some of our smaller clients don't have any programs. But again, going back to my point about they may not be as timely because of the volume of targets that are coming through or investigations. They may not be as timely to react to these types of issues and therefore not putting in place those preventative measures to then, respond or detect or shut down these fraud rings. And so they tend to be, the tail of those cases tend to be a bit longer than with, say, a larger, well-oiled institution.
Ray, if a financial institution detects suspicious payments or other evidence that might indicate unemployment insurance fraud, what should they do?
So it's simple, right? It's the requirements are that they investigate. Well, first spot those issues, right, and then second investigate the issues, and then potentially report a suspicious activity report to FinCEN and other regulators. And so, in that, for these types of unemployment fraud schemes, it's my belief that one of the reasons that FinCEN issued this alert is because of the sheer volume of these suspicious activity reports that are coming through from many financial institutions already, that they're spotting these things and they're reporting these SARs. And as such, the reason why the regulators issue the alert for many other banks, including some of our smaller banks, to say, hey, watch out for this, do your investigation, and then report those matters to us in a timely manner.
Ray, unfortunately, we are near the end of our time for this episode, but I was wondering if our listeners wanted any additional information on these topics. Where could they go?
Sure, Tom. As always, they can go to k2intelligence.com. We are also on LinkedIn and Twitter. They could also reach out to me directly. I have my contact information are up there if they need more information, Tom.
Ray, I wanted to thank you for taking the time to visit with me. One of the things that has become apparent to me in this podcast series is obviously things we were talking about in March and April are topics different than we're talking about now. And probably 6 months or a year from now, we'll have yet other topics. So I hope that perhaps I can call upon you in the future to visit with us about some of the challenges and risk management financial institutions will have going forward.
Absolutely, Tom. As always, a pleasure to be with you, and this is great. Thank you.
Hello, everyone. This is Tom Fox again. I'd like to thank you for listening to this episode of Compliance and Coronavirus. This is the only B2B podcast which brings clear and sane information for both the compliance professional and the business executive. If I could ask you to do one thing, if you could tell one person about this podcast, I'm trying to get the word out about this most unique podcast in the Compliance Podcast Network. So if you could tell one person about it, send them a copy, send them a link, do something to help me publicize this podcast, I would greatly appreciate it. Compliance and Coronavirus is a production of the Compliance Podcast Network, and it appears Tuesday, Wednesday, and Thursday of each week. Thanks again for listening, and I hope you'll join me again for another episode.